Welcome back to Investing Talk Podcast.
Today we're looking at Robinhood markets.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
You know, for the longest time, the narrative around Robinhood was pretty straightforward.
It was simple. High growth, disruptive tech, but ultimately a money pit that just couldn't seem to figure out profitability.
And that entire story has been turned on its head.
Completely. We are not talking about a growth at all costs company anymore. We're looking at a highly profitable firm that's really scaling effectively.
And the Q3 2025 numbers they're really the hard evidence here. Revenue came in around $1.27 billion.
Which is roughly 100% growth year over year. I mean, to nearly double your top line like that.
It shows incredible momentum.
But the real story, the part that caught everyone's attention, wasn't even the top line. It was how much of that revenue actually made it to the bottom line.
Earnings per share, right?
Exactly. It hit 61 cents. And when you put that against what analysts were expecting, it's a nearly 50% beat. They didn't just grow, they grew cheaply.
That idea of growing cheaply brings us right to that aha moment you mentioned earlier, operational leverage.
Yes.
Yeah.
And it's so important to understand for a business like this.
So for someone listening, maybe prepping for a meeting, what does that actually mean here?
Think of it like this. Robinhood spent years building everything. The technology, the compliance frameworks, the whole underlying infrastructure, those are their fixed costs.
They're already sunk.
Right. So now when trading volumes surge or they bring on 1 million new users, the actual cost of servicing them it's minimal. The expensive part is already built.
So every new dollar of revenue costs them way, way less to generate.
Precisely. And you see this so clearly in the financials. Adjusted EBITDA, which is a great measure of operational profit, grew aggressively, somewhere between 82 and 90% year over year.
That's huge profit acceleration. But the other side of that coin is what happened to their costs.
That's the kicker. Operating expenses only grew, 6 to 21%?
That massive gap is the very definition of leverage.
It is. Revenue is accelerating 4, maybe 5 times faster than costs.
Yeah.
And when a company hits that inflection point, the margins just become spectacular.
Which they have. The trailing profitability is showing a net margin of around 52% and a return on equity of about 21.7%. It's a machine now.
And all that efficiency feeds right into their financial strength.
Yeah.
I mean, they're operating with 0 long-term debt.
Which in a cyclical industry like finance is a huge advantage. It gives them so much resilience.
And flexibility. You can't have flexibility without cash.
Yeah.
And their balance sheet is, it's a fortress.
How much are we talking?
About $4.2 billion in cash as of the last report. And that is so significant because it lets them fund all their growth, all their acquisitions, without needing to go to the debt markets.
They're insulated from interest rate swings, and it seems like management is pretty confident in their own stock price, too.
Oh, absolutely. The board just upped the share repurchase authorization by another $500 million, bringing it to a total of $1.5 billion.
Okay, let me challenge that for a second. We often see buybacks after a stock has already had a huge run. Is this really creating shareholder value, or is it mostly just offsetting dilution from, stock-based compensation for executives?
That's a fair question, and a necessary one. In the short term, yes, a part of it is definitely to offset dilution. That's common in high-growth tech.
But $1.5 billion is a lot.
It's a serious commitment. It's a clear signal from management that they believe the stock is still undervalued, even after the run-up. They're saying this is a better use of cash than anything else they could do with it right now. It's a vote of confidence.
That makes sense. So let's talk about the engines driving that $1.27 billion in revenue. The core is still transactions, but where's the most exciting growth coming from?
The momentum is definitely in options and crypto. Q3 transaction revenue was high, around $730 million. But the real standout was the surge in their crypto business.
How big of a surge are we talking about?
Cryptocurrency revenue jumped about 300% year over year in Q3. It landed at roughly $268 million.
Wow.
And this shows you 2 critical things. First, Robinhood is perfectly positioned to capture that retail risk appetite that comes and goes with the crypto market cycle. And second, these crypto trades are often higher margin, which just adds more fuel to that operational leverage we were talking about.
But relying on the volatility of crypto and options, it makes you vulnerable to big swings in market sentiment. The really interesting long-term story seems to be this diversification into a super app.
That's the crucial pivot. They're trying to shift their revenue to higher quality recurring streams that don't depend on whether people are frantically trading on any given day.
And the best example of that is Robinhood Gold, their subscription.
Correct. Gold membership grew an amazing 77% year over year. They're at 3.5 million members now.
And that's sticky, predictable revenue.
Exactly. It's insulated from market volatility, builds a much deeper relationship with the user.
Beyond subscriptions, they're also pushing into areas that really get a user to consolidate their whole financial life onto the platform.
Right. Look at retirement products. The assets in the retirement accounts surged 118% year over year to $19 billion. They're not just a brokerage anymore, they're becoming a wealth manager.
And they're still innovating with new products like prediction markets, which are already bringing in an estimated $115 million in annualized revenue.
So they're building out the product moat, but they're also building a strategic moat through acquisitions.
What were the big moves there?
The two key ones were Trade PMR and Bitstamp. Trade PMR is a tech platform for wealth management. It's about accelerating their ambitions there, making it easier for financial advisors to use their systems.
That seems like a solid, almost defensive move. But Bitstamp, that feels different.
Bitstamp is the massive offensive play.
The global chess move.
It is. Acquiring Bitstamp, which is a really established crypto exchange, instantly gives them a huge international footprint, especially in Europe. With all the regulatory licenses already in place, it makes them a first mover in global regulated digital assets.
And that connects back to the CEO's comments about tokenization being the biggest innovation in finance in a decade.
It does. They aren't just trying to play better in the current system. They're betting heavily that the entire future of finance, stocks, real estate, everything is going to be on a blockchain-native architecture.
When they're building right now.
Exactly.
Okay, that's a powerful, fundamental story. So how is Wall Street reacting to this? Is the institutional money buying into this super app thesis?
They absolutely are. Institutional ownership is incredibly high, sitting at 93.27%. We've seen significant buying from major funds. The narrative has shifted. They now see it as a growth compounder that's figured out profitability.
Now, whenever a stock runs up over 200% in a year, you always see headlines about insider selling. What's the real story behind the executive sales we've seen?
You have to look at it with some nuance. Yes, there have been sales from senior execs, directors, even the Baiju Bont Living Trust. But the key detail is that most of this was done under prearranged Rule 10b5-1 plans.
Can you just quickly explain for our listeners what that is and why it matters?
Sure. A 10b5-1 plan is basically a pre-scheduled trading plan. An executive sets it up months in advance when they don't have any material non-public information. The sales then happen automatically based on the plan, regardless of the stock price.
So it's for personal diversification, not a sign of panic.
Generally, yes. It's seen by the market as routine. And while they're selling some shares, these insiders still have substantial stakes in the company. It's not a distress signal.
So the overall sentiment is bullish. That's reflected in the analyst ratings too, I assume.
Very much so. The consensus is a moderate buy, and we've just seen a whole bunch of price target increases. KeyCorp's at 155, BoFi at 157, Barclays is way up at 168.
And the average target
Sits around $137, which implies there's still upside even after this massive run.
Let's switch to the technicals. The stock is up, what, between 215 and 270% year to date. That's a huge move. Does the chart support more momentum?
Technically, it's in a very strong primary uptrend. It's trading well above both its 50-day and 200-day moving averages. I mean, that's the classic textbook sign of sustained bullish momentum.
But for listeners who might be looking for an entry point, a move that big can be intimidating. If we do get some volatility, what are the key support levels technicians are watching for a buy-the-dip opportunity?
The main area everyone is focused on is that $110 to $115 zone. That level represents a critical area of past support, and it aligns with some major moving averages. If the stock were to pull back to that region, many would see it as a favorable risk-reward entry point.
Okay, looking ahead now, what are the big catalysts over the next, say, 3 months?
The most immediate one is the Q4 2025 earnings release. That's expected in early February 2026. The market is going to be watching two things like a hawk.
What are they?
One, do they continue that amazing operating leverage story from Q3? And two, what's the initial impact from the acquisitions, especially Bitstamp? How's that integration going?
And what about those institutional flows we mentioned? When do we get more clarity on who has been buying?
That comes in two waves. First, you have ETF rebalancing in late November through early January. That can cause short-term volume spikes. But the really big moment is in February 2026, with the 13F filings.
That's when all the big funds have to disclose their positions.
Exactly. And that data can really drive the narrative and the stock's direction for the whole next quarter.
We've laid out a very strong bullish case here, but no analysis is complete without a hard look at the risks. Where could this story fall apart?
The first and most obvious hurdle is the valuation. Let's be clear. The stock is expensive. It's trading at a forward PE ratio somewhere in the 49 to 55x range.
That's way above the sector average.
It is. And when you trade at a premium like that, the market is basically pricing imperfection for years to come.
So any slip-up gets punished severely.
Exactly. One earnings miss, any sign of slowing user growth. The market will not be forgiving because the bar is set so incredibly high.
And the second big risk is that revenue cyclicality. Even with all the diversification, they still depend heavily on options and crypto trading.
And that's inherently volatile. We just saw a perfect example of this. The November operating update showed month-over-month volume declines across the board. Equity trading down 37%, options down 28%, even crypto was down 12%.
So that shows how hard it is to maintain that consistent growth.
It does. Finally, you have to talk about the constant regulatory overhang.
That risk never really goes away for a disruptive financial company.
Never. We've seen things like the Connecticut cease and desist order. And there's always this scrutiny around payment for order flow, or PFOF.
Can you just touch on PFOF and why regulators are concerned?
Sure. PFOF is how they make money on commission-free trades. They route your order to a market maker who pays them for that order flow. The regulatory concern is a potential conflict of interest. Is the broker getting you the absolute best price, or are they prioritizing the rebate they get?
That's the structural issue, but you mentioned their diversification helps mitigate some of this.
It does. If PFOF rules change, the growing revenue from subscriptions, interest, and wealth management acts as a crucial buffer. They aren't a one-trick pony anymore.
So to sum it all up for you, Robinhood has really made the leap from a speculative, cash-burning startup to a legitimate, profitable growth company. The inflection is real. You can see it in the earnings, the leverage, and the institutional buying.
The foundation is strong, no doubt. But here's the final thought to consider. Think about the long-term strategic advantage of that Bitstamp acquisition. Robinhood now has licensed crypto access across Europe and a huge regulatory footprint there. Does this give them an almost unbeatable head start against their US-only competitors when everyone inevitably tries to go global? This potential for global regulatory arbitrage, that might be the ultimate long-term growth driver that the market hasn't fully appreciated yet.
If you found this analysis helpful and want to stay informed on market-moving companies, be sure to subscribe to Investing Talk podcast.